Ladies and gentlemen, I'd like to welcome you back to part two of our three-part series, Capital Crest Financial Group presenting a smarter way to protect through life insurance premium financing. My name is Andrew Marin, and it's a pleasure to have you back with us. And with that said, let's jump right into it. Recall from last session that our borrowing options are usually 1 year or 30-day LIBOR plus a fixed bank spread. We also have the option for true bank fixed rates, as well as more sophisticated strategies such as swap rates. And our average loan terms are between 5 and 10 years. Now, there are three perspectives to keep in mind and see how everybody wins for this transaction. Well, the client no longer has a need to liquidate assets or deploy active capital to service insurance premiums. The insurance company receives overfunded insurance policies out of the gate, and the lender has fully cash secured credit from three sources, being the cash surrender value, the death benefit of the policy, as well as any outside collateral that would be pledged. So, common exit strategies. Well, the first would be funding the ILET. Each year, a gift of the entire annual exclusion could be made to the ILET. The amount of the gifts in excess of the loan interest cost could be saved or invested by the trustee. The trustee could pay off the outstanding loan balance and terminate the premium financing agreement and the premium financing arrangement at the appropriate time when the funds inside the trust are sufficient to do so. Using the cash value in the policy, the trustee could access and repay the outstanding loan balance. Caution must be observed by the trustee to assess if there's sufficient cash in the policy to do so to make sure that this policy will continue into the future. And this assessment is something that we can help with long term to make sure that we are picking the optimal time to do so. We can also use a grantor retained annuity trust. By making the borrower ILET the remainder beneficiary of the GRAT, the ILET receives any assets remaining in the trust when the GRAT terminates. The trustee may use these funds to repay all or some of the amount owed to the third-party lender. We can also use an intentionally defective grantor trust. The ILET is named the beneficiary of the IDGT. When the IDGT's installment note term ends and the note is satisfied, any remaining assets in the IDGT will pass to the ILET. At that time, the ILET trustee may use these funds to repay the loan obligation to a third-party lender. We also have the option to use a charitable lead trust. By naming the borrower ILET as the beneficiary of the CLT, any remaining assets in the CLT at the end of the term will pass to the ILET. And the ILET trustee may use those assets to repay all or part of the loan obligation. We could also look at a sponsorship prepayment, where we can structure a private loan to pay off the existing bank loan. And then passing of the insured is another exit strategy where the loan repayment may occur from the death of the insured. The loan is repaid from the death benefit proceeds before passing to the beneficiary because the lender is in first position until the loan is exhausted. Now, for any one of these trust-based exit strategies, you can certainly consult your own attorney or our attorney to explain how that would work and which strategy would be the best for your individual client. Now, we're going to look at two case studies, the first of which is John and Jackie. Now, they have a $50 million estate and two children. They have their full exemption left, and purchasing life insurance will provide liquidity and living benefits, including long-term care. So, John and Jackie are looking at a $10 million survivorship universal life policy. 7% crediting rate is the assumed rate here, and there are going to be two options. We can gift or we can borrow. And for gifting, the premium contributions would be $200,000 a year for 15 years. The cumulative out-of-pocket cost to John and Jackie are $3 million, and that would eat away at their exclusion, lifetime gift tax exclusion, by $2.58 million. The alternative is to borrow. The interest contribution will be in full for 10 years. The cumulative out-of-pocket cost will be $1.25 million, and their exclusion reduction would be reduced to $834,000. Now again, in both of these figures, we're assuming current gift tax exclusions. And again, John and Jackie in this hypothetical have two children, $14,000 per beneficiary, which equals $28,000 per year that can be gifted. And the cost savings under the borrowing structure is $1.73 million. Now we're assuming that those savings are going to be reinvested at a 5% annually compounded return for a 15-year period. And the lesson learned here, and one of the ideals of our firm, is don't solve one problem today by creating a new one in the future. And the meaning behind that is, if we can have a smarter, more comprehensive interest contribution program or structure that will not inadvertently eat away at our lifetime gift tax exemption, that's something that should be explored so that we are not creating a problem in the future by solving one today. And we're going to look at two case studies. One's going to be an income planning study. The other one is going to be an estate planning study. On the income planning study, our client profile is 18 to 55, average or better health with the desire to retire before age 70, that same desire to maintain inheritance value, and expects their net worth to increase. In this example, we'll see the potential benefits are $100,000 plus in tax-free income, as well as a $5 million plus death benefit. And the objective for income planning is to help increase family wealth while providing tax-free income for the insured. Again, this is an investment-grade life insurance policy. The client contributions in this case study are going to be $28,000 a year. The life insurance death benefit and income are tax-free, and the plan can provide long-term care and living benefits. Or the alternative to doing this would be to pay $34,800 per year up until age 100 for a similar product. Now, this is what one of our strategy sheets looks like. I promise it's not a daunting task. We will all be experts in this by the end of this series in the next 15 minutes or so. But this is what a standard strategy sheet, as we call, looks like. Now, in walking through each piece here, we have proposed for, in this instance, value client, the carrier which we're using, the death benefit. And if we come to the right here, we're looking at the borrowing rate beginning at 2.85%, the crediting rate, we're assuming a 7% crediting rate, the cumulative out-of-pocket, the client's exposure, and then the maximum collateral required that they would have to pledge in the early years. Now we'll walk through each one of these one at a time, and then we'll see how they all fit together. So the first here is going to be the year. This is the year of the policy. The age of our client, we're assuming a 40-year-old male. Column 1 is the annual financed premium. Now that is, this strategy is a 7-pay max non-MEC, which equals $195,767 in annual premium for 7 years. Column 2 is the beginning loan balance. That is going to be the principal loan. Column 3 is repaying the loan and then accessing the cash in the policy, which we'll touch on in just a moment. Column 4 is the principal loan plus any deferred interest. Column 5 and 6 work together. Column 5 is the annual interest total, and column 6 is going to be our loan rate. Now, our loan rate that we're assuming here is LIBOR plus a fixed bank spread, and we are looking at this with LIBOR increasing at 15 basis points a year after year 2 to stress test this policy moving forward. So if you were to take the loan rate, which is LIBOR plus the spread, of the ending loan balance, again, which is principal plus any deferred interest, that figure will be here reflected in column 5 for the annual interest in any year. Column 7 is going to be our annual out-of-pocket. That's the client's contribution to this policy. We're capping the client's exposure at $28,000, so they're not eating into their lifetime exemption. Again, they have 2 children in this scenario, so we can have them gift up to $28,000 towards the interest of the policy. Column 8 is the surrender value, or the actual cash in the policy itself that is growing in the market. Again, here we're assuming a 7% rate of return on that figure. And then column 9 and 10 are not mutually exclusive. This is showing one piece of collateral, so it's not two, not one to the bank, one to the insurance carrier, but it's showing it in 2 different ways. So let's go to column 10 first. Column 10 is the shortfall between the ending loan balance, which is the principal plus deferred interest, and the actual cash in the policy. So if you take these two numbers, you will get this. So if you take $51,000 this first year from the ending loan balance plus deferred interest, you will equal out to $144,013. Now that needs to be pledged in collateral to the lender so that they are fully cash secured, no matter if the client passes away prematurely or decides to walk away from the policy for some reason. The bank will be made whole again 100%. Now, that is assuming this surrender value again growing at 7%. But what happens if we don't get 7% every year? What if we get something lower? Well, that's what column 9 is showing here. That is showing the projected bank collateral, or what the minimum would be in the event that the policy performs at the guaranteed minimum of the policy. So not assuming a 7% rate of return, but rather a 1% rate of return on each and every year here. So this would be the maximum peak collateral the client would have to pledge, again, assuming this strategy here. So this is more realistic, but certainly to show the client what it could be moving forward. And again, these numbers don't look too far off here. It's not a drastic change, but when we're dealing with much higher premiums and perhaps the client servicing more or less of the interest, those numbers can be quite different. And so it's important to make sure the client has the wherewithal to weather a few bad years and perhaps some more peak collateral. Now, column 11 is the death benefit. That's going to be the face amount of the death benefit of the policy, and 12 is the net death benefit. So in any year that the client passes away, unfortunately, prematurely, what you would do is you would look at the net death benefit in any one of those years, and that's what the beneficiaries would realize. We would be taking the ending loan balance away from the death benefit to repay the lender, and then the rest would pass to the beneficiaries. So now that we know what each piece does individually, let's see how they work together, and we can put everything back in one place. So in presenting to a client, we would say, Mr. or Mrs. Client, we have an annual finance premium of $195,000 that's going in annually for 7 years. And we are going to have you pledge collateral for the shortfall between the actual cash in the policy and the ending loan balance. In this instance, the collateral is for 6 years. This can be from marketable securities, a letter of credit, cash or cash equivalents, non-qualified annuities, etc. And then we'll let this policy grow. All along the while, you'll be servicing a portion of the interest. And once we get to year 13, there's enough cash in the policy to repay the outstanding loan balance. So we'll take a loan for $800,000 against the policy, and then we'll exhaust the loan for another chunk of $879,000. Now the loan is terminated, the bank loan is terminated. If you notice, these figures now equal out the death benefit and the net death benefit because there's no longer somebody else in the first position there. And the client has access to this insurance policy to last for the rest of his life for the death benefit protection, as well as for an income protection plan, where the client at age 65 can start taking distributions from the surrender value of the policy to last for the rest of his life. Here we're assuming a 2% inflation on those figures. And it's important to note that unlike an annuity, there's no time that the client has to start taking out of this policy. Again, the client doesn't have to access any cash in the policy. If they wanted to for 1 year and then never touch it again, they most certainly are able to. Or if they want to set up a stream of income, something similar to this, it's most certainly an option for them. So this is our first case study of 2, and we'll jump into the next one, where we're going to have John and Jackie's case that we were looking at earlier. Again, for an estate planning study, we're looking at clients aged 55 to 89, average or better health with the desire to maintain their inheritance value, significant cash flow but values the flexible payments, expects their net worth to increase, and in this example, the potential benefits are to dramatically reduce any gift tax consequences as compared to gifting those premiums directly, and we'll see a $9 million plus death benefit at life expectancy. And the objective is to help increase family wealth and reduce potential gift tax exposure. This is investment grade life insurance. We are looking at client contribution to the plan in full for 10 years. Life insurance death benefit is tax-free, and the alternative would be the client servicing $122,000 for this policy up until age 100, or the passing of the remaining insured, again, for this survivorship policy. Now, exact same layout. The only thing that's changed are the parties involved. So again, this is a survivorship policy for $10 million. Our borrowing rate and crediting rate has stayed the same. With the exception of the parties changing, our 7 pay is still intact. This time it's $699,000 per year. Clients are older, policy is larger, so the insurance premiums have gone up. And our client is servicing interest in full for 10 years in this scenario. Now, we have our client getting a bank loan. The bank is funding these premiums for 7 years. That money in the cash surrender value of the policy is growing. And in the 13th year, we can look and see, are we able to repay the lender? And the answer is yes. In the 14th year, we take a loan for $2.9 million from the cash of the policy. And then in the 15th year, we exhaust the loan with a secondary loan of $3 million to repay the lender. Now the lender is completely out of the picture. These figures now balance out, and at life expectancy, let's assume it's somewhere in this area, we would be looking at close to or in excess of $9 million for the death benefit. Now again, their cumulative out-of-pocket is $1.25 million. They needed to pledge collateral for a total of 5 years in this policy itself. And the alternative to this would be to pay $122,000 for the rest of their life for a policy similar to this. Now again, these strategy sheets can be procured for any client of any size, and it really helps to explain, we feel, on one page, the lending component as well as the insurance component of these transactions. Now, this is a disclosure. We want to thank you very much for being with us here today for part 2 of our 3-part series on life insurance premium financing, a better way to protect. And we will open the floor now to any questions and answers as they come in.